My name is Erwin Rode. I'm from Rode and Associates. We are real estate economists and property valuers. Welcome to this session of CPD development. The purpose of this presentation is to give you an insight in the influence of the world economy on the South African economy and also, therefore, in turn, on the South African property market. You may not know, but it's a fact. Maybe our politicians don't know it always, but we are not an island. South Africa is not an island, and neither is the property market an island. We are influenced very strongly by what's happening outside. So let's get cracking. This quote is one of the best I've seen on the reason for this financial crash we had in 2008 in the US of A and in other countries thereafter. Check out what this Morgan Stanley chief economist Stephen Roach at the Davos summit in 2005 already said. That is 4 years before the crash. He said, US consumers suck money out of their homes. What he meant is, you go to the ATM and you increase your mortgage bond. They suck money out of their homes to fuel imports from Asia, while governments there buy dollars, keeping interest rates low in the USA and allowing consumers to borrow more. This is an utterly insane way to run the world economy. Now, I must tell you that it's not only the fact that the Asians were buying American bonds. Something else happened. Once in 500-year phenomenon in China, which made China return to the world of competition, and with them sucking in work from the developed countries and producing goods very cheaply, they eventually depressed prices in the developed world, including the USA, which made inflation just about disappear in the developed world in spite of this sucking of the money. Which reminds me of another term that was coined during this crisis. It was by one Robert Shiller, a very well-known economist in the United States. He started using the term also a few years before the crash. He called it irrational exuberance. And what you're looking at here today is the price movements of houses in the United States from 1950 to 2015. And you'll notice that from 1950 up to about the year 2000, prices were moving in a horizontal channel. As you would expect, because remember, these are real values, so we've taken out inflation. And you would expect over time that the real values of properties would move sideways, unless you expect properties to age, which of course you would expect if you knew anything about property. But we're not going to dwell on how much properties tend to age or by how much they tend to age. Suffice it to say, in the United States, the rule of thumb is about 1 percentage point per year relative to new. So if a house is 20 years old, then you would expect that house to stand at a discount to a brand new house next door, a 20% discount because of aging. Well then, you can see there that then from 2000 onwards, this graph just shot through the roof. Remember, this is in real terms after having taken out inflation, which is completely irrational, because what this implies, this peak, what it implies is that people were paying prices well above replacement costs. That's the implication. Now that is irrational exuberance, if ever there was anything, right? And then, of course, the inevitable bubble burst, or the burst became inevitable, and we saw that drastic correction taking place. And lo and behold, there's some more growth coming as we speak, and already in 2015, the prices were already again above the long-term trend line, which to me is indicating that properties are on the expensive side once again in the United States. So, should the world economy falter, start stuttering, it's quite possible that that graph line will turn down again. and come right down to the bottom of that graph, round about 85 or so on that specific graph on the y-axis. Right, so now you know what irrational exuberance is when people are irrationally paying prices for stuff that they can actually manufacture more cheaply. It's a behavioral thing, and it's a new branch in economics. Just to show what the world had been doing, that graph shows you up to 2013. Unfortunately, it has been updated to 2015. The growth in the debt as a percentage of GDP in the world, in other words, the whole world, and it excludes the financial sector's debts. So you can see there that out there, the consumers were doing things that they hadn't been doing before. And that, of course, explains partially what happened. So we can sum up the world's situation by saying that the developed world must deleverage. It's a fancy way of saying it's the developed world has got too much debt. And of course, that can take a very long time indeed. Let me quote you the example of Japan. Japan, the property bubble burst in 1990, and they are still battling with very low growth, virtually no growth. How many years later? 25 years or so later and counting. So it's not impossible that the world will go through a similar phase in the years to come. So in our personal planning, just bear that in mind, be conservative with your finances. Let's now come to South Africa. First, the big picture. South Africa is in the unfortunate situation. What this graph is showing us is that, look at the third column at the bottom, you'll see in red there that about 50% of South Africa's population at the moment is below 25 years of age. Now, of course, you can guess what the implications of that is for our economy. On the one hand, the optimist will say, well, all these people have to buy bread, so there's going to be a huge demand for bread. But the pessimist will say there's no way that this economy of ours can provide jobs for all of them. So I'm quite convinced that that all the troubles South Africa is experiencing, and I'm now speaking in March 2016, the troubles we've been having over the past number of years, and now especially also at the university, is a symptom of this problem of an economy that cannot provide enough for everybody. It's simply not possible. Right, South Africa has been consuming and consuming and consuming. I would like to compare our policy since 2008 with that of China. After 2008, economists agreed that the way to combat this problem of the economy crashing was to pump money into the system. It's called pump priming, or it's also known as the Keynesian solution to the problem. In other words, government must initiate huge projects in order to pump money into the system to get the economy going again, very simplistically stated. Now, you've got two options, really, if you come to think of it. The Chinese took the option to invest in infrastructure, so-called fixed investment, bridges, roads, you name it. South Africa took the option to appoint more civil servants and to raise their salaries by more than 2 digits per year. As a result of which now, we have a civil servant complement that is far higher than what we can afford. And I've got, on good advice, I've got information that the typical salary in the public service at the moment is about 20 to 30% higher than what you would get in the private sector, comparing like with like. So you see, the fiscus in South Africa has got a huge problem at the moment. And as a consequence, of course, these rating agencies, these credit rating agencies, are threatening to de-rate us to junk status, which will mean that South Africa Incorporated will pay much more in future for interest, should this happen. And a lot of money that used to flow into South Africa will reverse now and will flow out. And you can imagine what that could do to inflation, what it could do to our balance of payments, to interest rates, and so forth and so on. So as we speak, we are on very shaky ground. Speaking of which, here's the forecast of GDP growth for South Africa. That delta sign means change. We've got two forecasts here for South Africa. The one is what we call the Rode forecast. That is a survey we do every 6 months of top economists in South Africa. We ask them for their forecast, and you can see the average forecast until 2020 is only 2% growth. That's the very bottom figure. For the IMF forecast, there's, lo and behold, is also 2%. Quite a coincidence. So we are really looking in the medium term to growth that is going to be quite low. That's the most reasonable expectation out there. Compare that to the world economy as forecast by the IMF. The world economy is forecast by the IMF to grow at an average rate of 3.8% over the next few years until 2020. So you can see South Africa got serious problems. And those forecasts are by, I mean, I would argue the IMF is impartial, so it's not as if somebody's trying to put South Africa in its place. Right, to sum up then, the prospects for the SA economy: lower growth in the wake of low world growth and infrastructure constraint in South Africa. So it's not only the world that's unkind to us, we've been unkind to ourselves too. And here I'm referring especially to things like the Eskom debacle. We know that's a constraint on growth. The fact that our roads are in a bad shape, excepting the roads done by Sanral. That's the full irony. The Sanlam roads are actually in very good nick. And in the Western Cape, the roads are also, from what I can gather, in a good nick. But certainly we have backlogs with the roads, we have backlogs with Transnet, and then I'm not even mentioning SAA and a few national companies like that. Good, so that means that taxes and tariffs will have to rise even further, and therefore, what we can say is that the Reserve Bank and the Fiscus they've now run out of ammo. Initially, they had the following ammo. In 2008, our debt to GDP ratio was very low. It was about 25% or so. That is now heading for 50%. So we've shot that ammo away by borrowing money and spending that on, not on infrastructure, but on civil servants. The second type of ammo that all governments have, of course, is by lowering the inflation of the interest rate. And we've done that now, and we can't go any further for obvious reasons. And so the Fiscus and the Reserve Bank, they really are in a corner because they've shot all their ammo. So we will have to prepare ourselves for times that are quite lean. Consumers are highly indebted because South Africa we are poor savers, and this goes back many, many years that we are poor savers, and that means that we are completely and utterly dependent on outside capital flowing in. So we need to be managers in whom the outside world got a lot of confidence, to put it that way, to look at it as a company. South Africa needs to be a company well run for foreigners to have the confidence to invest in us, because we are completely and utterly dependent on their goodwill that they want to invest in us. Now, there are two types of investment they can make, the foreigners. One is the so-called portfolio investments, which are not worth much, but it helps in the shorter term. That is money that comes in as investments because our interest rates are pretty high compared to, say, the European interest rates, for example. But at the drop of a hat, that money can flow out again. And we're seeing that happening as we speak because the foreigners are losing confidence. The second type of investment, which is the type of investment you really want, is a more permanent investment. That is when foreigners come to our country and they invest in factories or buying farms and things like that. That money doesn't come in and out. They are here for keeps, more or less. And unfortunately, we're not getting enough of that. Right, and as I've mentioned before, the other structural problem we have is that South Africans, that 50% of South Africans are below 25, and there's no ways that our economy, unfortunately, can provide jobs for them. No matter what you do as a government, no matter who governs this country, it is a huge problem. So, expect the ride to continue. Right, to illustrate vividly where South Africa stands, you're looking at the growth in real GDP for South Africa compared with the world. The world is in the red, the broken line in the red. You'll see immediately that South Africa's GDP growth is more volatile than the rest of the world, and that's easy to explain because South Africa is an exporter of commodities, and commodity prices are quite volatile. They go through cycles. But you'll also see that from about 2011, South Africa has been falling behind the world, and the forecast is for that difference to continue. So we are certainly underperforming the world, and we have to ask ourselves, how did it all come about? You'll notice that our interest rates are quite highly correlated with that of the United States, and our interest rates being the red broken line. See the high correlation there? When they come down over a long period, ours also come down over a very long period. So we are integrated into the world economy. If ever there was any doubt about it, there it is. Which brings me to the big property cycle. The property cycle is very long, about 15 to 20 years. And prices are made in the long term, are driven in the long term by replacement costs, also known as building costs. And that's the purple line on the top graph. So in the long run, property prices are driven by replacement costs, which is very logical. But then in the shorter run, just to give you the cyclical effect, you've got prices or market rentals, if you like, oscillating around this long-term trend line, as you can see there, because of things like interest rates that are changing, economy that's accelerating or decelerating. These are the shorter run reasons why you've got this oscillation around the long-term trend line. Now, if you were to deflate that those rentals or market values, the dotted line, in other words, the dotted blue line, you deflate it by using building costs. In other words, you take the dotted line and you divide building costs into it, and you multiply it by 100, then you get the bottom typical wave formation. Now that wave from bottom to bottom is anything from 15 to 20 years. So you could imagine this is a very important bit of news for investors, because if you consider that the typical person works only for 40 years, then you've got twice in your lifetime the opportunity to buy property cheaply, and twice the opportunity to buy it very expensively. It's your choice. And if you don't know about it, well, you have to come to the Rode conferences to find out more about this long cycle. But in the meantime, note that this cycle is in real terms, right? So we've taken out building cost inflation. It moves sideways. That's the theory. And the reason, of course, is that when prices go, when they reach the apex, what happens in practice in a free market like ours? Well, prices are now so expensive, homes are now so expensive, office buildings are so expensive, and market rentals are so high that it now pays developers to flood the market with new developments. And that's exactly how our free market works. The price is the normal, natural, automatic corrector of price movements. So it always comes back to the mean. That's the terminology that's used by financial economists. They say it will revert to the mean. Prices will revert to the mean. In this case, the mean, of course, is a horizontal line, which I haven't drawn on the picture. There's one problem with this model, And I read it for you there. Because of supply side constraints, this model does not work in, for instance, the City of London or the Atlantic seaboard in Cape Town, where God doesn't make any more land, but demand goes on growing. In the case of the City of London, it is the financial center of the world, as we know. In the case of Cape Town, well, we know we are very popular. As somebody said, yeah, but you must remember, all the beautiful things of Cape Town are God-made, that they are not made by man. Which is not completely true, because there is the V&A waterfront, isn't there? You know, the interesting thing about property is it's very similar to commodities. Here's a very wise quote for you in red. The commodity cycle is created as follows. What ends the cycle is high prices, and what ends low prices is low prices, right? So what it is saying is what I've just told you about property. When prices are very high, as we've seen in commodities recently in the world, then of course lots of new mines are being opened, and that of course creates an oversupply, and Bob's your uncle, then of course you go through quite a number of lean years again for balance to return to the market. In case you didn't believe me about the very long cycle in South Africa, the property cycle in the United Kingdom, the construction cycle is about 15 to 20 years. And there I give you the source. I didn't suck it from my thumb. Now, the reason is why construction cycle is also as long as the property cycle is very logical if you come to think of it. What comes first is the economy, then property, and then construction. So in the footsteps of property, the construction cycle is also going to follow a similar cycle. Isn't that logic? I would think so. And here's South Africa's cycle. Now, this is valuable stuff. I compiled that many, many years ago, and I keep on updating it every quarter. What you're looking at is real office rentals. In other words, we've taken out building cost inflation. Real office rentals, that is the red line, the broken red line, from 1960 to today, plus a forecast. And we're comparing that with real house prices in the blue line. And you'll see that they followed more or less the same pattern. Why? Because they share one economy, right? So you'd expect them to follow the same trend more or less, or the same cycle, barring maybe 1 or 2 years of leading and lagging, because let's take the case of office rentals. From time to time, when the market starts accelerating again, maybe at that stage there is still a 15% vacancy in offices, so it'll take time for that 15% to be absorbed, and before rentals will then react. But then something strange happened. In the year 2000, notice once again the year 2000, the two-parted company, and office rentals went down in real terms, and as house prices just kept on rising. That was the irrational exuberance boom that we also had in America. And as opposed to America, after the crisis of 2008, our prices here didn't come down in real terms, not by much at least. They've been more or less moving sideways in real terms. Now, what does it tell us? It tells us that in real terms, prices are still very high in South Africa, and that's why we are forecasting. That's what why our model is forecasting that in the next 4 years or so, 5 years, that prices will in real terms come down. Now please note, that doesn't mean that in nominal terms prices will come down. What it means is that when inflation is 6%, expect house prices to grow at say 3% per annum, or 2% or 1%, something like that. But they're not necessarily going to decline unless we are going to head for a very serious world crash, which is unlikely, but is possible. Right, in the case of office rentals now, we are forecasting a slight rise in real terms, which is another way of saying that office buildings in general today is not overpriced. I would argue that house prices are still overpriced, but offices certainly aren't overpriced, except that we've got this niggling thing of the pretty high vacancy rates that we have at the moment. Here's another example of the very long construction cycle, this time in South Africa. You can see we're starting in 1946, that's just after the war. These are actual buildings put in place in South Africa by the private sector, And in this case, it's housing. It's not non-residential, it's only housing, private housing. And you can see the first cycle was 16 years, the second cycle 16 years, the third cycle was 20 years. The current cycle, I think, is not heading for bottom as yet. That 16 years with a question mark, I think, is a bit premature. I personally think that the bottom is going to be quite a few years in the future. So the current cycle is going to be 20 years plus. It could even be as long as 25 years in my view. So please prepare yourselves for lean times. That is my view. I'm just a messenger, don't shoot me. I'm not responsible for all this. Right, I think it's a reasonable question, but how does property perform as an investment? And here you are seeing return statistics, which you won't see anywhere else in this country. I'm showing you the total returns on institutionally owned property. In other words, typically what the old mutuals and the Liberties and the Sanlams of this world used to own, and in some instances still own. What more do the REITs now own, of course. And we, once again, because of the long cycle, when looking at the returns, it's very important to do it in cycles. Don't mix two cycles with one another and then calculate an average return. It'll give you a skewed picture. So I'm doing it per cycle. The first cycle there is 16 years. It would have been 18 years if we could have done it from 1960, but unfortunately we haven't got data for 1961 and 60. But there is our total real return is 4.8%. The very bottom cell, 4.8%. From 1962 to 1977. The next cycle of 19 years gave you 4.2% total real return, and the third cycle gave you 7.2. Now you can see that 7.2 is out of sync with the previous two long cycles, because that included the period of very low interest rates and the declining interest rates, because we were capable of getting inflation under control over that period through very high interest rates. And then they came down, of course, through this monetary policy that the Reserve Bank had instituted during the cycle. So the 7.2 is not, and I repeat, it's not the normal sort of returns you could expect over a long cycle. Rather think in terms of 4 to 5% total return, real total return. Now what do I mean by real? I mean I've taken out inflation. What do I mean by total? It's the combined yield of the income yield plus capital return. So the two combined, income return plus capital appreciation, gives you your total return. And that's what you should be looking at as an investor. And if you are following a so-called naive buy and hold strategy with a big portfolio, that is typically the sort of returns you can expect. 4 to 5 total return, real terms, over a long cycle. In order to improve on that, you've got to do clever things. You've got to be a developer who makes few mistakes. And please note, a developer who makes few mistakes. You are going to make mistakes, but just make fewer mistakes than your successes. So you've got to do clever things and up your risk in order to improve on those 4 to 5% total real returns. The residential market. It's just to show you where we are at the moment with house prices. At the moment, we are comparing here year-on-year growth with month-on-month growth, and they are more or less at the same, the growth rate is more or less the same at the moment, around about 6%, which is quite a high, in my opinion, at the moment, given where we are and given what's happening to the economy at the moment. My explanation for the good returns that we're still seeing or have been seeing until the end of last year, beginning of this year, is that these huge salary increases that were granted to the civil servants last year are still having an effect on our house prices. Right, the prospects for house prices. Growth over the next 5 years will be below inflation because prices are still very high in real terms, as I said before. Consumers are under unrelenting stress, and as I explained, because of the situation in which the fiscus is, expect this to continue for a long time. On top of that, interest rates will keep on rising for two reasons. Basel III and the interest rate cycle. Now, Basel III, I'm not going to go into the specifics here because I haven't got the time, but Basel III, in essence, what it does is it makes banks more loath to invest in mortgage bonds. The problem there is the matching of the assets with the liabilities in the bank's balance sheet. In the bank's balance sheet, a 20-year mortgage bond is an asset, and the liability is maybe a 3-month deposit by a member of the public. Now, you could imagine that creates problems for the banks, especially now in terms of Basel III. And then, of course, the interest cycle, we know interest rates have to rise. Banks increase their risk aversion, therefore, and thus prices will revert to the mean in the medium term, as I explained. Now, very few people want to believe that, and I don't believe it either, but I insist it will, and therefore it will. Right, and here's our actual forecast year by year for house prices. You can see that for 2016, our model is forecasting 6%. I think it's too optimistic. I think it'll be closer to 2 or 3% for this year. So this is just a model, doesn't mean that we can't use our common sense either. And for next year then 4.4%, 4.2, 4.1 and so forth and so on. You can see that is about 5% then that the model is forecasting, and inflation is going to be 6% plus chances are over that period. So I must say the model is more optimistic than I am. Oh yes, and by the way, to come back to the influence of the economy on house prices, you will see there the 2 bullets we've got there. The drivers of house prices are prime interest rates that have a negative relationship with house prices. In other words, the higher the interest rate, the lower house prices, all other things being equal. And secondly, the long-term trend line is building cost inflation, which has, of course, a positive relationship. All right. Now, I presume I'm speaking to estate agents and to brokers, property brokers, and of course, your income stream is to a large degree determined by mortgage loans. In other words, what I'm trying to say to you is that mortgage loans passed by banks, new mortgage loans, are a good proxy for your income, for the number of sales that you are going to conclude over a period, let's say over the next year. And that's historically what you see there, the blue line from 1978 to 2015. What happened to the number of sales, more or less. It's a proxy for the number of sales. And you'll see, of course, to the run up to the big crash that we had in 2008, 2009, thereabouts, that an inordinate number of sales took place, and of course you guys were doing very well. Thank you very much. Yeah, by the way, I say number of sales, it's actually value of sales. So it's not only the number, but the value is also increased, of course. But it was a good time, but that was an abnormal period. Please listen and believe me, that was very abnormal. It's not going to happen again. I would argue that a more normal level of number of sales would be around about what we had in 1995, thereabouts. And at the moment we are slightly below that. Good, our forecast for next year, here it is. No, for this year, for 2016, we are forecasting that the number of sales, or the value rather, of mortgage bonds passed, to be more correct, will decline by about 10%, 9.4. But next year it's going to jump back, hopefully, but from a lower base. So we'll probably be at the levels of 2015 and 2018 again. So yes, as conveyancers, as estate agents, as home valuers, take note, things can get a bit rough. The retail property market. The most important point I would like to make about the retail property market is, yes, our analysis shows that South Africa is not overpopulated with shopping centre space. And the reason, of course, is that we've had this, over decades now, this huge boom in consumer expenditure. Our wives and our girlfriends are the best shoppers in the world. They are tops. So that's why we can build all these shopping centres. But How do these shopping centers do? Now, here's an interesting statistic. Let's first of all check out super regionals. You'll see there that from 2003 to 2013, that's about 10 years, the trading densities of super regional shopping centers increased by a compound rate of 8.2% per annum. Over that same period, the consumer price index, in other words, normal inflation, was about 6%. So what it tells us is that over that 10-year period, the trading densities of shops in this country housed in super regional centers did better, slightly better than inflation. That's good news. From 2013 to 2014, just a 1-year period, no, it's a 2-year period, similar situation, slightly better than the inflation rate, super regionals. However, the smaller the shopping center, as we go down the list to regional and small regionals and so on, you'll find that the trading densities were quite significantly below the CPI, below inflation. Now, why is this important? Well, trading densities is a proxy for the turnovers, well, it is the turnovers of shops, of retailers. And that, of course, in turn is a proxy for how much the retailer can afford to pay in the form of rental. It's a rough proxy. So what we are seeing here is that the smaller centers in South Africa are probably under quite a bit of stress. That's even forgetting about the possibility that the operating cost, as we know, is growing at a rate of knots. Right, so the message to me is I would rather invest in a super regional shopping center. So if you have 2 billion lying around, I would invest in the super regional shopping center rather than in a small regional. What you're looking at here is we are comparing the growth in real retail sales, in other words, after having taken out inflation, with disposable incomes of households. And as you would expect, there's a high correlation between the two. The higher the disposable income of a family, the more they can spend in the malls. Right, that's logical. But note the interesting thing that is happening as we speak. From about 2014, that shaded area, you'll notice that that disposable incomes are going down quite steeply, but retail sales keep on growing. And that's quite an anomalous situation. The anomaly has happened before. We had a similar situation in 2006, but it's certainly happening again. And the question is why? Well, retail sales are not only driven by disposable incomes, they're also driven by credit extended. And that brings me to the next slide. Credit extended to households is, in this case, the red dotted broken line. And you'll see how it came down quite steeply since about 2013, thereabouts, whereas retail sales are still quite strong, relatively speaking. So I must say I can't fully explain what's happening to retail sales, excepting that we will defend our right to spend money to the last man. But logically I can't explain it. But it does mean, if you can't explain it, that maybe this is something that's going to change in the short-term future. After all, I mean, something must give. I mean, if your disposable incomes are declining or stagnating, and you're not spending, and you're not getting extended loans from the banks, something must give. The office property market. The most important thing I would like to point out to you here is that the demand for office space is governed by the GDP of the services sector. That is people like, the Americans call it FIRE, finance, insurance, real estate, that sort of stuff. People sitting in offices behind computers, they want you to believe that they're actually working. So it's logical that growth in those number of employees will drive the demand for office space. Not so. And you see there's quite a good correlation there. R squared is 0.7, which means that about 70% of the changes in the demand for office space is determined by changes in in the employees, the GDP of the services sector. In other words, companies employing more, companies doing well in the services sector. That's what it really amounts to. Notice that the office demand was more or less negative for a very long period. Now, at first glance, that looks horrible. You'll see that it was below the zero line since about 2008. At first glance, you would think this is horrible, but there is a catch here. This data is for grades A and B office space only. And over time, what happens is grade A becomes B and B becomes C, and C is not represented here. So it does give us sort of a skewed picture of what's been happening to the demand for office space. But nevertheless, this very short hiccup that we are seeing there, I can't explain it. And neither can I explain the GDP services sector that's been doing so well in 2015. Suffice it to say, I think that both are going to head south soon. And the reason why I think that is that vacancy rate is still quite high. You see the the long-term trend line is about 7% vacant. That is the broken red line. And the green is the actual vacancies for grades A and B. And you can see it is well above the average of the past 20, 30 years, 25 years. So it's still high, and what are the prospects of it declining fast? I would say not great, given what's going to happen to the economy. Now, the interesting thing about this graph, it shows us that in Gauteng, the Pretoria office market, office rentals have been catching up with Joburg grade A office market. The rentals have been catching up. And that just underscores the fact that the New South Africa was very good to Pretoria. Because in Pretoria, what you had was this influx of new civil servants into the inner city of Pretoria, and then the white flight to the east, where a lot of new townhouse developments, of course, have been taking place. And with it, the huge growth in office demand and office supply that has been happening in Pretoria. So Pretoria is a completely different city to what it was 25 years ago. And the guys who were prepared to invest there, I think as a generalization, they did quite well. Right, here's our forecast of office rentals. And in doing this forecast, we are giving you two scenarios. The first scenario we call the consensus scenario. That is the sort of scenario that most economists, the sort of forecast of GDP that most economists would give you today. In other words, less than 2% growth for the next 2 years and maybe slightly more for the 2 years thereafter, sort of thing. And you can see under that scenario, we're talking about 6% growth this year in rentals, 9% next year, and 9% the year thereafter, no, 10% and 10% thereafter, which is not too bad at all, especially if you consider that inflation is going to be maybe 6 to 7% thereabouts, then it's not bad. Now, just to check it and see about what will happen, because nobody knows for sure what's going to happen, of course, to the world or South Africa's economies, we also have what we call the junk rating scenario. In other words, we simply assume that South Africa is going to go through tougher times than what your average economist at the moment think, and that the average growth rate over the next few years is only going to be 0.5 percentage point per annum. Not 2%, as is under the consensus scenario, but less than 1%, say in this case 0.5% per annum. Just to give you the worst case scenario, and you will see in a situation like that, this year and next year, 2016 and 2017, negative growth in rentals, and thereafter slowly picking up, but still below the inflation rate. So that's more or less your worst case scenario for offices. Oh yes, and the determinants, what drives office rentals are changes in the office vacancy rates, which is quite logical. That gives you your shorter term fluctuation, not so, and your long term trend line, once again, you've guessed it, is building cost inflation, which of course has got a positive relationship with rentals. Right, that brings us to the industrial property market. Once again, I just want to point out here that the central Witwatersrand has been losing out compared to the rest of the of South Africa's industrial property markets. The dotted broken line, the broken red line, is represents national industrial rentals, and you can see from 1990 onwards they have been catching up slowly but surely, and at the moment they are on the same level as the Witwatersrand, Central Witwatersrand. And my theory about this, why this has been happening, is twofold. First of all, I think the Central Witwatersrand is becoming more services oriented and less industrial oriented. So that is a structural thing that's happening. And the second structural thing that is happening is that the mining sector is of less significance nowadays to South Africa's economy than it was 20 years ago. So we are seeing that Johannesburg, which is very dependent on mining because of all the services to mining that is in Johannesburg Central, they have been, presumably, they've been growing at a less exuberant rate than what was the case previously. And that's my explanation. I'll never forget, I discovered, I had a house price index many years ago, and I discovered at one stage that house prices in the Cape were, and we're talking about the mid-80s now, were catching up and surpassing those here up in Johannesburg. I mean, at one stage, those of you are more or less of my age will remember that day when, those days when, and we're talking about the 70s now, that when somebody was asked to relocate from Cape Town to Johannesburg, you had to give the person an increase, a salary increase, to pay for the higher housing costs. Those were the days. By the mid-80s, that started changing, and today, of course, it's the other way around. House prices in Cape Town are higher now than they are in Johannesburg, and the reason for that, I think, is very simple. That the Cape's economy is more diversified, and because of that, we weren't as much affected down in the Cape as the Johannesburg economy was affected by the change in the commodity markets. Now, you might recall that in 1980, the gold price crashed, and with it, of course, the local economy here on the Witwatersrand also was affected. And that's once again a story I'm telling you to illustrate the fact that house prices are very much influenced by what's happening in the general economy. If the economy is booming, house prices will also boom. It's virtually a given, and vice versa. Right, so let's look at industrial rentals. Once again, we've got two scenarios. We've got the 2% per annum scenario, which is nowadays the consensus scenario, and you can see there industrial rentals growing at a reasonable rate, more or less the inflation rate starting next year, even better than the inflation rate. And of course, under the junk rating scenario, as bad as under the as is the case with office buildings. Right, the following variables are usually statistically significant in explaining changes in industrial market rentals, which is a fancy way of saying that industrial rentals are determined by, number one, industrial vacancies. That is logical, exactly as is the case with office buildings. And secondly, the long-term trend line, of course, is building cost. That's all very logical. By now you know it out of... Right. Market rating, in other words, a fancy word for capitalization rates. Now, those of you who don't know what the capitalization rate is, in the case of income-producing properties, it is the expected net income of year one, assuming the property is let at market rentals, divided by the market value or by the price, whatever the case is. So, because of this definition of what a capitalization rate is, when capitalization rates decline, it effectively means that prices are rising, holding constant all other things. I know it's counterintuitive when you first hear it, but do your sums and do an example on paper and say, okay, I've got 10 Rand net income for next year, and the price that I've bought the property at is 100 Rands. 10 divided by 100 Rands gives me a 10% income yield or capitalization rate, and then redo the exercise where the the capitalization rate now is not 10% but 11%, and you'll see that the effect of that is that market value has now dropped. And here you're looking at South Africa's capitalization rate starting in 1990, quarterly figures, and you immediately notice that in the middle of that graph there's a steep drop in capitalization rates. Now remember, I said to you, dropping capitalization rates are actually good news because it means values are rising, holding constant all other factors, right? So what caused all this? This sharp drop that we had there in around about 2003 to 2006. South Africa got inflation under control, and with it, interest rates could come down, and with it, capitalization rates could come down. And then, of course, with the financial crisis in 2008, we had this bump up, very short rise, short and sweet, and thereafter, cap rates in South Africa have been trending down, 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 down. Now, that is a wonderful news. What does it tell us? It tells us that investors in South Africa are very confident about the long-term long-term value of investing in property, in income-producing property in South Africa, because they've been prepared to pay more and more rands for the same cash flow. That's really what it means when you say that capitalization rates are declining or income yields are declining. You're prepared to pay more and more for the same expected cash flow. Now, of course, this was to a large degree caused by the REITs, the real estate investment trusts in South Africa, the listed property funds that had a very good rating, and I haven't got the time today to go into that, but over the past number of years, the real estate investment trusts had a very good rating, very low income yields that had been declining all the while, so they could buy in at keener and keener prices directly held properties. And don't forget, what you're looking at here is the capitalization rates are directly held properties, not listed properties. So that to me is the explanation why, well, one of the explanations why capitalization rates have been trending down for such a long time, and why the property market has been doing so well, whether listed or unlisted. Now the big question is, we know that as at the 9th of December last year, starting more or less at the time, the long bond rates in South Africa, long bond yields increased quite drastically, and the question is, what does that combined with junk rating going to do for property? We've got a model which tells us that cap rates during the course of this year will probably increase by something like 70 basis points, 70 bips. In other words, 70% of 1 percentage point. Which of course is bad news, because all other things being equal, it means that prices are going to decline. But remember, I said all other things being equal. By that I mean that we're assuming then that rentals are not going to keep on rising slightly, right? In practice, I suspect the two will more or less cancel one another out. Right. The following variables are usually statistically significant in explaining changes in market capitalization rates. As I've just explained to you, the long bond yields, they are definitely one of the drivers of capitalization rates. It's logical if you come to think of it, because it's an alternative investment to property, long bonds. Vacancy rates is the second one. There's a positive relationship. In other words, as vacancy rates rise, your capitalization rates also rise, which is bad news. But vacancy rates in itself, of course, rising vacancy rates are also bad news. And then thirdly, real GDP. There's a negative relationship. The faster the GDP grows, the more cap rates decline. And that's also logical, because why? Because when GDP starts rising faster, the market out there expects that eventually, maybe with a lag, market rentals will start accelerating, right? And with it then eventually market values. So it's all very logical. Right, that brings us to our conclusions. I'm just going to sum up now more or less what I've been telling you. The world economy and infrastructure backlogs and sovereign debt ratio of South Africa are constraints on our economic growth. As I said before, the sovereign debt ratio has more or less doubled over the past 5 years or so, 5, 6, 7 years, and we've now reached the limit. So we are being watched with eagle's eyes by the rating agencies. And yeah, so that's definitely put a ceiling on how much we can grow at the moment. South Africa, we are poor savers, thus financial markets will keep the South African fiscal policy on the straight and narrow, one hopes. If not, we are going to follow the same route as, say, Brazil, or if worse, then even Zimbabwe, you know, populist policies. It is, we hope that's not going to happen, but that is a worst case scenario, should we not follow the straight and the narrow. I know our new Minister of Finance is trying his best, but of course it doesn't only depend on him. There are other players as well, not so. Right, so residential properties are still expensive. I know many people won't believe me when I say that. Office properties are fundamentally cheap, but vacancies persist and prospects are mediocre. Why? It's not because properties are expensive, as I said, they are cheap, but the prospects for the economy are mediocre, looking into the future a few years. Industrial properties are also fundamentally cheap for the same reason. Of course, the beauty of industrial properties is that your risk is lower there because very little industrial properties are built on spec as opposed to office buildings. Right, our highly indebted consumers face challenges. The number of civil servants and their salary increases will have to moderate in years to come. There's no doubt about it. Of course, that is going to be the difficult thing from a political point of view. But it has to happen. If not, we are in serious trouble. Thus, more cash flows will remain under pressure, especially malls in working class locations, and I might add, especially malls, smaller malls. The not so big malls, the regional sized malls, rather than the super regional. Or the small regionals. Right, and then South Africa is heading for an extended period of upheaval. And the simple reason is that there are expectations out there that the economy simply cannot meet. It's as simple as that. I always compare South Africa with a boat on the Congo River. It's got a 1914 German engine in it, diesel engine, doof, 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 doof. And more people are jumping on this boat, more and more. And how long is this engine going to last? Because this engine isn't strong enough to drive this boat with all this weight on it. That is the biggest risk that Africa in the long term is facing. And please guys, I'm just a messenger. And I thank you very much. And I hope you can apply this in your work, in practice. And before we ring off, just remember, my company does a few things. We're not only the messengers of ill tidings, we are also valuation guys. We do valuations, we do publications. We've got Reuters report, we've got Reuters SA Property Trends, which is a forecast report, 6 years into the future. We've got Reuters Retail Report, the name explains it. We do lots of ad hoc consultancy, and we also do town planning. Thank you very much. Please don't forget, there are 10 multiple choice questions you've got to answer in order to get your points, right? You've heard it. Thank you very much.